Navigating the investment landscape. The interplay of age and risk profile in asset allocation decisions. Introduction. In the realm of investment strategy, the dynamic relationship between an investor's age and risk profile assumes a central role in shaping asset allocation decisions. The age of an investor, coupled with their risk tolerance, establishes the foundation upon which a well-structured portfolio is built. This interplay guides the allocation of assets across diverse investment classes, influencing the potential for returns, volatility exposure, and the overall resilience of the portfolio in the face of market fluctuations. Age is a determinant of investment horizon. The significance of an investor's age in asset allocation decisions stems from its direct correlation with the investment horizon. Younger investors typically have a longer time horizon before they may need to access their investment funds, allowing them to weather short-term market volatility and capitalize on the compounding effect over an extended period. Consider a 30-year-old investor with a retirement horizon of 30 years. This investor can afford to allocate a higher proportion of their portfolio to equities, which historically offer the potential for higher returns over the long term but come with increased volatility. The extended time horizon provides the flexibility to withstand market downturns and benefit from the growth potential of equities. Risk tolerance as a guiding light. An investor's risk profile, often informed by their tolerance for market fluctuations and financial goals, acts as a guiding light in the asset allocation process. Risk tolerance is a subjective measure influenced by factors such as income stability, financial obligations, and psychological comfort with market volatility. For instance, a conservative investor approaching retirement may prioritize capital preservation and income generation, favoring a higher allocation to fixed income securities such as bonds. This approach seeks to minimize exposure to market volatility and protect the capital accumulated over the years. Aligning with the investor's lower risk tolerance as they transition into a phase where capital preservation becomes paramount. Dynamic asset allocation across life stages. Asset allocation is not a static concept but a dynamic strategy that evolves with the investor's life stages. Younger investors, with time on their side, may initially lean towards a more aggressive allocation, emphasizing growth-oriented assets like stocks. As these investors age, approach major life milestones, or experience changes in risk tolerance, the allocation may shift towards a more balanced or conservative mix to safeguard accumulated wealth. Consider a mid-career investor who has accumulated a significant portfolio. While their risk tolerance may still allow for exposure to equities, the asset allocation strategy may incorporate a more diversified mix that includes fixed income securities and alternative investments. This balanced approach seeks to capture growth opportunities while mitigating the impact of market downturns on the overall portfolio. Diversification as a risk management tool. The age and risk profile of an investor underscore the importance of diversification as a risk management tool in asset allocation decisions. Diversification involves spreading investments across different asset classes, industries, and geographic regions to mitigate the impact of poor performance in any single investment. A young, risk-tolerant investor may choose to diversify by allocating a portion of their portfolio to international equities, real estate, or emerging markets, aiming to capture diverse sources of return. In contrast, an older investor with a lower risk tolerance may diversify by including a mix of government and corporate bonds alongside stable dividend-paying stocks. Seeking a balance between income generation and capital preservation. Market conditions and tactical adjustments. While age and risk profiles set the broad parameters for asset allocation, market conditions and economic trends can prompt tactical adjustments. During periods of economic expansion, investors may tilt towards growth-oriented assets, while economic downturns may necessitate a shift towards defensive assets. Consider a scenario where interest rates are rising. An older investor, seeking to protect their portfolio from interest rate risk, may adjust their allocation by reducing exposure to long-term bonds and increasing holdings in shorter duration or floating rate securities. This tactical adjustment aligns with their risk profile and the prevailing market conditions, showcasing the adaptability required in successful asset allocation. The role of professional advice. Given the myriad factors influencing asset allocation decisions, seeking professional advice becomes a prudent strategy for investors of all ages. Financial advisors leverage their expertise to assess an investor's unique circumstances, goals, and risk tolerance, tailoring asset allocation strategies that align with individual financial journeys. Conclusion. In the intricate dance of investment management, the age and risk profile of an investor emerge as guiding forces, shaping the contours of asset allocation decisions. The strategic interplay between these factors not only defines the risk-return profile of a portfolio but also reflects the investor's financial goals and life stage. As investors traverse the diverse landscapes of the financial markets, a thoughtful and dynamic approach to asset allocation, rooted in an understanding of age and risk tolerance, becomes the compass that steers them towards the realization of their financial objectives.